Hi guys, so today I'm going to go over how to solve for WACC for Agilent Technologies, why they're a great company to invest in, how capital restructure for this company will change their WACC, and just kind of some company information. So Agilent Technologies is a research, development, and marketing company, manufacturing company, I apologize. They do all kinds of sciences, research, from life sciences to robotics, really just a great company. They started in 1990 as a spin-off from Hewlett Packard. When they did issue their initial public offer, it was the largest in Silicon Valley history at the time that they did it. They, billions in net revenue every year. They're just a great company to work for, on a cutting edge of technology. Really a fantastic firm. I'm going to kind of compare them to one of their competitors, and kind of show the pros that they have compared to them, and then also explain why they need some capital restructure. So right over here we have some other stuff that we use, or all the stuff that we use to calculate our cost of debt, our market returns, to get our expected market return minus our risk-free gives us our MRP, comes out to be 10.15%. 10.15%. You take your tax expense divided by your income before taxes, and that gives you your average tax rate for that year. This is a little high, but it was so low last year. The average is out to about 40%, which is kind of the industry average, so don't be alarmed for that. Over here is our cost of equity if we were using the dividend growth rate. It's really low at 6.74%. We use that, calculating that with our average growth, our share price, and our projected growth rate for 2019. Over here, we're going to calculate our first WACC using dividend growth rate, but also we're going to show kind of the capital makeup, of the company. What percentage is equity? What percentage is debt? So 93.03% of this company is equity, and then the other 6.97% is debt. So the company we're going to compare to, which is Bruker, they're about 40% debt, which is 60% equity, which puts them in a lot higher risk for bankruptcy than we do here at Agilent Technologies. Being 93.03% equity is something you don't have to pay back. You do have to issue. We do issue dividends, but it keeps us a lot higher rate of non-solvency. So over here, we have our cost of debt, our weight of debt, our tax rate for this year, which was 66%, minus 1 comes out to be 34%. Our cost of equity, our weight of equity, and then our WACC comes out to be 6.41%, which is pretty cheap. All right. And then we're going to change it up and using the capital asset pricing model to get WACC. It changes our cost of equity. It makes that 14.27%. That comes out, once we plug that in for our cost of equity, it changes the WACC to 13.42%, which is so heavy. It changes just so heavy because we are so equity strong in our capital, in our capital. But I would definitely say that our dividend growth rate is more accurate when calculating our WACC. So much cheaper, and we have a lot more information and data that helps justify why I think going with the dividend growth rate and having a cheaper WACC is justified. So, all right. So going into our restructure of capital, and while we're restructuring, we want to issue $10 billion worth of shares, so we can take that $10 billion and use it to fund our research and development of our artificial intelligence. So we're at a point in human history where our technology is so advanced, and we're just on the cutting edge of here at Agilent Technologies, that I really think that if we really pour our heart and soul into it, we could be the first company to develop such technology. And if that technology would develop, not only would it be a huge step in the science community, but it'd be a huge step for mankind, and what a lot of people would I consider could be the greatest achievement of mankind's history. So just a slight chance that someone could develop that, and I don't think there's anybody more equipped to do it than us here at Agilent Technologies. It's really simple. It's going to be issuing the shares. This is $10 billion, but we are so capital heavy, it's not really going to affect our weighted average cost of capital. So $10 billion, that brings our equity up to $34 billion. It changes our total capital structure to 35, almost 36 billion. That changes our weight of equity to 94.98%, and it brings our weight of debt down to 5%. So calculating that gives us our new WACC of 6.5%, which is just barely, not even 0.1% higher than we were before. So it really doesn't put us at trouble with bankruptcy. Doesn't put us out there. It doesn't change a lot of things. It's not like these companies going to be in danger if we take this chance to research such a thing. Take a big chance as a firm. It's not really taking a big chance, because we already are so equity heavy. It's not like money we have to pay back. We're here at the cutting edge, so I really think this is something we could do. So I definitely think it was, if I had $10 billion, I would definitely invest in this company, because, being $75, if we, our share price, $75, we create artificial intelligence out of Agilent Technologies, that stock price would skyrocket, and that 10 billion would easily turn into, several, obviously maybe even trillions. So I definitely think we're a company worth investing in and giving a thought about. So that is my reasoning and justification for investing in Agilent Technologies.